I'm the founder of MEM Investment Research, and I'm really happy that you could join me today. I look forward to helping you become more knowledgeable about the markets. Today we are going to be reviewing how to use volume. And this really might sound like a boring topic, but it's actually very, very critical. It's very important. It's going to be by combining this volume that you see in a particular stock or in the broader markets with other activity, it's really bring your trading to the next level if you have a full understanding of what the volume is telling you. So I will go ahead and share that information with you and ideally help bring your trading to the next level. Why don't we go ahead and get started? I can give you a bit of background regarding who I am. As mentioned, Mary Ellen McGonagle, and I do have over 25 years of experience Wall Street related, and I'll take you to the beginning. As a young graduate from college, I had the highly unusual ability to pursue and gain a job at Goldman Sachs, and it was through a headhunting firm, a friend that I had started it, and it was a wonderful experience. I was on their trading floor, the fixed income, lots of commotion, millions, billions of dollars being traded, and really was just a wonderful way to start my career. I did leave Goldman Sachs to go to what's called the buy side, and I was with a very large insurance firm in New York City, and again in the fixed income department. I started out as an assistant on their trading desk. I did go on to become the head of that desk, and I was managing at one point $2 billion in assets, and it was during that time that I really got a feel for, this was during the 80s, how managing a lot of money gave an individual access to information, I would say ahead of the public certainly. And luckily since then the SEC has clamped down on that. It certainly wasn't illegal, it was just the way things were done at that time. But now information is available to everyone at the same time, and I think that's wonderful. Again, the playing field is leveled. It's allowed the individual investor to have access to the same information as these professionals, and it's really a great opportunity for individual investors who want to trade and are trading your own account, because now you can have access, and if you continue to educate yourself with webinars such as today and bring your skill level up, it's going to really benefit you so that you can outperform these markets. You're not going to have the same issues as far as getting in and out of stocks. You're going to be able to be more nimble. So all of this is going to be quite helpful. So after I did leave New York, moved out to the West Coast with my then new husband, and I had the opportunity to join William O'Neill and Company. And as many of you may know, he is the founder of Investors Business Daily. And I was on in what was called the institutional sales side, and that position allowed me to meet with many of the top portfolio managers and analysts throughout the world, and my role was to teach them the O'Neill methodology and also advise them on the markets and their stocks. And I was there for over 15 years, and it was a wonderful experience. More recently, I've started my own investment research firm, MEM Investment Research, and with that I provide a weekly newsletter to my clients. And I do still have institutional clients. With them, I do quite a bit more in the way of hand-holding in addition to the weekly report. But again, to give you a bit of background as far as who I am, and I'm really excited at the opportunity to share my many years of experience and my knowledge with the self-directed investor. And to me, that's been one of the more exciting aspects of this. So before we begin, I do have this disclaimer, and as mentioned in prior webinars, I am not going to read the entire thing, but most notable is that this presentation is for educational purposes only. There is not any recommendation to buy or sell any securities. So let's go ahead and I'll begin by reviewing with you what we are going to be covering today. As mentioned, volume is really critical. It's a key component. I would say O'Neill's work would tell you it's the most important aspect when you are looking at a chart, and we'll go ahead and review why that is so important. We'll also review 5 things that the volume in a stock can signal to you, the investor. And thirdly, we will review what technical indicators work best when you are seeing volume. And then the 4th item that we'll go over is called accumulation versus distribution. And these 2 terms come into play when volume is clustered together. So we'll review both of those, and we'll also review how you can use this accumulation versus distribution to your advantage. And then lastly, using history as a guide. As with all of my webinars, we will be using charts. Most of them are up to date, but we are using history as a guide. We'll look at examples of when volume came into play so that when you see that same occurrence in your stock, you can take action. So let's go ahead. We'll start at the very beginning. I mentioned why that volume is critical and is very important, and we'll go ahead and review exactly why. And when I'm talking about volume, I'm talking about the number of shares traded in a particular stock or in the broader indexes. And as you know, volume is recorded as daily. You can also review weekly and then even intraday volume. But either, no matter what time period you're viewing, volume is indeed very important. And it does help in determining quite a few things, including the potential direction of a stock, the strength or weakness of a stock. So as mentioned, we'll review those 5 indicators that volume puts forth to you. But the reason volume is so important is because an increase in the number of shares traded, that indicates that institutions are in buying or selling a stock. It's not an individual buyer or seller that's going to cause this big pickup in volume. And this is really important because these institutions are the ones that are really going to move a stock up or down. And by institutions, of course, I mean mutual funds, pensions, hedge funds, and insurance companies. And these firms are running billions of dollars, and their buying can easily constrict the number of shares that are readily available out there to the point where any additional buying is going to drive prices higher. And this process of institutions coming in and accumulating is how bases and breakouts and then eventually run-ups in a stock take place. And so when institutions start buying a stock, you really need to pay attention. And I often call this institutional accumulation in a stock smart money. And the reason is, while the information and the resources have been opened to individual investors, individual investors do have access to that same information. Oftentimes, as an individual investor, you don't always have the time or the resources to really dig in and uncover key information. For instance, these large institutional brokerage firms, they often hold conferences where CEOs and CFOs present, and they are attended to by these analysts and sometimes portfolio managers, and they provide updates on where the company is headed, what they're doing. Now, the individual investor can listen to these conferences and to replays, but oftentimes you're not going to have the time. Other items include the ability for these analysts to go visit the companies, visit the competitors. So while the playing field has leveled, there is still a little bit of an edge, I would say, for these institutions. So when they do start buying or selling a stock, as an individual investor, you want to pay attention. And other things that volume, and we will review this, but when a stock starts picking up in volume, often if it's to the upside, it's indicating strength. And if you are a technical, inclined toward technical analysis, you'll see that volume is one of the most key elements and tools in technical analysis. And so we're talking about accumulation. Now, on the flip side, as stated, if institutions decide that it's time to reduce their exposure to a particular company, or if they feel that the stock is fully valued, their selling really needs to be paid attention to. And you'll see this in a pickup in the volume. And then if the selling continues, it'll indicate that the stock's under distribution and you'll want to exit the stock. And again, we will review examples of all of this. So a lot of times when reviewing and talking about volume, perhaps you'll read this or individuals will state to you that the stock is trading in high volume. And sometimes that might not mean much to you, but I did want to explain what is high volume. And there are a couple of ways to define that. And one of the most common, if you are looking at charts, is generally speaking, you want to look at the average volume over the last 50 days. And most charting services will provide you with this. There'll be a line that goes through the volume, and that line is indicating to you the average over the last 50 days, so that if the volume goes above that line, that's telling you that it is above average and high volume. And on a weekly, it's going to take you back 10 weeks of price history and looking at the volume. And another way really is quite simple, and I find this really effective. Just quite simply looking at the chart. So when you're looking at the chart, and again, we'll review some examples, and the price information correlates directly with the volume below it, visibly you can see that volume bar. Is it high relative to the historical volume? And it sounds simple, but it really is quite effective. A lot of times, or oftentimes, you'll read lists at the end of the trading day, stocks that have traded up on volume. Well, you'll want to go ahead and look at that chart, and indeed you'll see visibly that that volume is quite ahead of what it has been trading on average. Now let's go ahead. I talked about accumulation versus distribution. And we'll start with accumulation. And in short, it's when a stock is moving upward on above average volume, quite simply. And then distribution, on the other hand, a stock is being sold on above average volume. Now, both of these terms refer to what I would call sustained moves, as opposed to only one day. You might have a stock that's one day it's up on volume, one day it's down. But if you start to see a number of days clustered together, they don't have to be immediately after one another, but they are clustered together within a weekly, 2-week period, that is considered accumulation. And it can also be viewed when you're looking at a weekly chart where the stock has traded higher in price and the volume has been higher than average. And then likewise with distribution, where the stock's been trading lower in price, again, over a period of time and on above average volume. So generally, you want to, of course, get into and then stay in a stock that's under accumulation, and then you want to avoid or get out of a stock that's under distribution. And again, we'll review some examples here. So there are several ways that you can determine if your stock is under accumulation or distribution using overlays, technical overlays. And one way to gauge this is to use what's called an accumulation distribution line. And this is a line that will be above or below your chart. And it is designed to measure the cumulative flow of money into and out of a security. So really basically, and if anyone wants the calculation, I can email it to you, but very basically, it calculates where a stock price, let's say on a daily chart, where a stock price closes the day relative to its high and its low in price for the day. And generally, if the stock closes in the upper 60% of its range for the day, that's a positive. And then the calculation takes into account whether it was on volume or not. And that is going to tell you if it closes in the upper 60% of the range on volume, the stock is under accumulation. And so what happens with this calculation is, again, it takes the average, smooths it out, and provides you with a line. And if, of course, it's upward sloping, it indicates the stock is under accumulation. And then for distribution, if the stock closes in the lower portion of the trading range, and it does so on volume, and that's going to be a negative, and it will drag that accumulation distribution line in a downward fashion. There are certainly other indicators that can be used. For those of you that, for instance, read Investors Business Daily, they use a letter system. And the letters go from A to E, and then C is neutral. A indicates strong accumulation, and then E is strong distribution. So that's another metric that those of you that subscribe or have access to that service, you can use that. And what you're looking for in both of these metrics is a move from neutral to ideally positive, or from neutral to negative on volume. And then lastly, again, I mentioned you can quite simply eye the chart. And you can really tell a lot from viewing the volume bars below the price action. So again, while basic, it really can be quite effective. The other thing I did want to mention is what's called accumulation distribution divergence. This is a screening item in working with my institutional clients. It can be really helpful, for instance, for hedge funds. And here's what you're doing. When I say divergence, what you are looking for in this instance is when you're looking for potential reversals that are not obvious to the chart that you're looking at, but the way that you would screen for this kind of thing is if you see an uptrend of a stock and their price is trending up while the accumulation distribution line is going down, that suggests that there is underlying selling pressure. And in many cases, that can turn into a bearish reversal of that uptrend, and we will review an example of that. Likewise, the opposite occurs when you see a stock that's trending downward in price, but the accumulation distribution is in an uptrend, and that's indicating underlying buying pressure. And in this instance, it could foreshadow a bullish reversal in prices. So again, we will be reviewing examples of that, and you can see precisely what we're talking about. So let's go ahead. I mentioned to you that there are 5 things that volume can indicate. And the first one is so important. We did review it. It's telling you that institutions are involved, and that institutional involvement is going to be critical to sustain that move, be it upward or downward. But that is the number one thing that volume can indicate. Secondly, it can indicate that the stock is starting an uptrend. So oftentimes stock will meander sideways or form what we call a base. If it breaks out of that base upward, and it does so on volume, that's indicating the beginning of an uptrend. Thirdly, of course, is the beginning of a downtrend, and stocks, when they break down on volume, you need to pay attention. We'll review some examples where you can overlay other technical indicators, and if you see a breakdown below those indicators, you need to exit the stock. We talked about the divergence, and that is another item that volume can indicate. And then lastly, you can use volume to tell you whether an industry group is rotating in or out of favor. And there are two ways to do that. One is using the S&P ETFs for those sectors. And if you review them on a weekly basis, you see activity on volume, that's going to tell you that there could be a downtrend in play. The other item, if you are an individual who likes to do screening, or if you notice that there are a number of stocks within a given group that are going up on volume, for instance, more recently semiconductors over the last 2 months, you may have noticed, and that's going to give you an indication. If you see many stocks in a given group start to behave upward or downward on volume, that's giving you a heads up that there is a rotation into or out of a given industry group. So how to pinpoint entry and exit points, and this is going to be very important to you. First is if the stock gaps up on volume. Again, that volume is going to be critical, that institutions are the ones that are pushing that gap up, and that move could continue. If a stock, I mentioned this, if it breaks key support on volume, you'll want to exit. And then when a stock breaks out of a base on volume, that is a buy point. And then lastly, it's important that you have a system to screen for these high volume events. And I do know that a lot of the trading platforms out there now automatically tell you which stocks are trading, but I've found that a lot of times they will tell you AT&T and Apple. Well, they're going to be the most volume because they're the largest. What you want to screen for is stocks that are trading on above average volume for their particular average. For that individual stock's average volume, is it picking up above average? So that's going to be quite a bit more critical to helping you uncover these stocks that are potentially beginning an up or a downtrend. So let's go ahead. We'll get started. Here is the first example that I wanted to point out to you. And what you're looking at here is a monthly chart of Biogen. I did want to be able to show you a monthly because it does work as well as a weekly or a daily. And in this particular case, we're taking you back to the end of '07. And in this particular case, this was a multi-year base where the stock was, this of course was the '08-'09 downtrend, and the stock, as it broke out of this base, it did so on very, very big volume. And in this case, it was the beginning of a very, very extensive move. In fact, there were many biotech stocks that experienced this move. But again, this breaking out of a base on big volume was your first indication that a big move was ahead of it. Let's go ahead and take a look at a stock. Now this is a more recent, we're looking at here a daily chart of Take-Two. It's a software company, and again each bar represents 1 day of activity. And what I've done in this case is using stockcharts.com. They have an accumulation distribution line that you can plot, and again the direction of this line is indicating as it's going upward the stock is under accumulation. But what can be even more useful is to overlay a 50-day moving average of this accumulation distribution on top of it. And so what you are screening or looking for here are when you have crossovers. So in August we did have what would be considered a negative crossover, but when you look at some of the other indicators, in this case the 50 and the 200-day moving average, this crossover looks to be more an aberration than anything to be concerned about, because the stock held support at an upward trending 50-day moving average. But more recently, what we've seen is this crossover with the accumulation distribution going down through the average is accompanied by huge volume. And again, this is the daily, so this is taking you back over the last Friday, and I'm trying to think what day this would be, but it's over the last couple of days, huge volume. And more importantly, take a look at the position of the stock relative to its 50-day moving average. I talked about distribution, when it would be critical to pay attention to it, and in this case, now the stock has broken below that 50-day moving average. So we've had several days of high volume. It's broken its key support. So this would be a stock that if you owned it, you would want to exit it. I actually, as I mentioned, had mentioned this stock over the weekend to one of my hedge fund clients as a possible short, and indeed it has continued to trade down. But more importantly, when you're looking at that moving average and you're looking for crossovers, you do want to put it together, the picture together with that volume, with the moving averages and that key support. So this volume is indeed quite heavy. So let's go ahead and take a look at another example here. This we're looking at here is a daily chart of NVIDIA, and I mentioned to you earlier that when we see volume occur as a stock is gapping up. Now this is taking us back to the end of February, and you can see there are 3 days clustered together, and each of those days the stock gapped up. The highest gap up on the biggest volume day, but indeed you had 3 days of gap ups on volume that were a precursor to a move up. And then again here in mid-May, both of these are in response to a strong earnings report. The stock gaps up again, and the volume in this instance is just tremendous. And to see a continuation on the daily of above average volume, again we're just eyeing it here, you can see it's above average. Indeed, it is indicating to you the stock has strength. Institutions are in here buying and supporting the stock, and then in this case I didn't indicate it, but the stock broke out of a base on above average volume. So you continue to get indication, but your initial gap up here in price on volume really was your first sign that this could be a very strong stock. Now this next is the same chart, and what I've done here is I overlaid technical indicators. So I talked to you about that before, how you can put this price and volume action, and when you can put it together with other positive technical indicators, it's really going to give you even that much more power and confidence to enter the trade. So during this first gap up in price, we had, and I do have other webinars that review this further, but we had positive what's called RSI, relative strength indicator, and that's when it went up above the 0. And then below this I have what's called the MACD, and again, other webinars go into this, but we had a positive crossover there. And then we also had a positive crossover of your key moving averages later. But earlier you did have these other two indicators that coincided with this big gap up in price. So when you can put technical indicators together with these gap ups, it's really, again, going to get you in front of these stocks with these big moves. And same indication here. This gaps up, RSI turns positive, MACD turns positive, so your uptrend has continued for a great period of time. So, but again, the beginning indicator was that volume. So let's go ahead and take a look. I mentioned that we would be reviewing negative or divergences, and in this case, this is what's called a negative divergence, and it was a warning. And this is the stock that I actually owned personally back in that May-June period, and when this started to occur, I was able to exit the stock before more damage came to it. So what we are looking at here is, in particular, the end of June, the stock price started to attempt to rally. And in this case here, during this time period, it was flat. But if you take a look at the accumulation distribution line, you can see that it is turning downward. So despite this attempted rally, there's a very, very strong downtrend that's indicating selling pressures are beneath it. Now, the stock did go ahead and try and retest this high, but at the end of the day, this negative divergence really was the beginning of a much longer term downtrend. So that's an example of a negative divergence. Here is another example of a negative divergence, and what we're looking at here is Barrick Gold Corp. This is a daily chart, and take a look here, and this could be true of a number of these gold stocks. Back in the end of that June period, the stock is just barreling to new highs. But if you take a look at the accumulation distribution line, this negative crossover, during that same period, this is very, very much in a downtrend. And again, we had the same occurrence as CRM that we were just looking at, where the stock indeed attempted to hit that prior high, but this negative divergence was your first sign that the downtrend was imminent. And then as we cross below this 50-day moving average, you can see this pickup, and that's telling you that distribution is underway. So as for instance, hedge funds, when they see this kind of action where it's hitting new highs, oftentimes they will short and they will sit through this second bounce. So you definitely would need to have the stomach for that. But again, it very, very often leads to much more serious downside. So here's another example, and this is again a recent chart. We're looking at Burlington Stores, and it's a daily chart. And looking at taking a look at this May period, this is the end of May, and this stock at that time came out with excellent earnings. It gapped up, but take a look at this volume pickup even prior to that announcement. And this again is a daily, but you can easily see that the stock is coming under accumulation. So this stock gaps up, and you can see where it is indeed the beginning of a significant move. In mid-July, we had another huge gap up on volume, and in this case, the company was raising their guidance for their next quarterly earnings, and the stock again gapped up, huge volume, and went on to greater heights price-wise. Now, let's take a look because in this example, we're getting both the positive and the negative. So this is more recent activity in the stock. So we do have a pickup here in the volume over the last couple of days, But technically what's happening is the stock is breaking down below key areas of support. If you look back historically, this is the 10-day, this green bar, and for your faster moving stocks, that is a more effective indicator or moving average to use. And all along during that uptrend and even in the sideways period, it's finding support. But now it breaks below the 10-day, which may or may not be alarming. But once we break a 50-day and it's on volume, that is when you need to reassess your position in that stock. I would say to exit it, and you're getting confirmation from other technical indicators such as the MACD is now negative, and your RSI turned negative back here at the end of September when it first broke that 10-day. But again, you're getting an example of both sides where volume is going to be a really critical indicator that there's been a shift in sentiment in the stock and a reversal of either the downtrend or the uptrend. Now let's take a look. I talked about negative divergences. Here is an example of a positive divergence that marked the start of a reversal. You're looking here, and this is a recent chart of LVS is Las Vegas stands. This is a daily chart. So what I'm keying in on here is the period at the end of June. During that period, the stock was very, very much in a downtrend. It broke both the 50, the 200-day. It did so on volume. By every right, you would not want to be in this stock. However, clearly a different signal was being given by the accumulation distribution line. While not clearly in an uptrend, it's sideways. And that's telling you that there's some underlying buying that's going on that's keeping this from being in a severe downtrend similar to the price action. So during this downtrend, there are individuals, institutions that are in there buying it. So it's the kind of thing that when you identify this through your screening, from my work, I would not be a buyer until it crossed back up above it, but it would be something that would hit your screens that a reversal could be in the cards. And indeed, we did get that reversal. And further down in late July, you saw a gap up, huge volume. This volume was well above average as well as it broke above key moving averages. And then more recently, the beginning of September, again, another big price gap up, huge volume. This is telling you that institutions like the stock, they're in it, and it's the type of thing that's going to propel this and really help sustain this upward move. And then Chipotle. Many of you may be familiar with this stock. This is a weekly chart, and it's taking you back to the middle of 2014. And what I did want to point out to you here is the stock, as it was breaking down, take a look at this volume. And this is a weekly, so this is over several weeks, actually a 5-week period, but 3 of those weeks were exceptionally high volume. And most importantly, when it broke the 200-day moving average, that was your signal on huge volume that the stock, you need it to exit it. The volume on that particular week was 153% above average, which is really quite huge. And of course, as we know, the stock has gone on to much lower lows and continues to struggle. And then here's an example, again, recent. It's a weekly chart of Amazon. And what I wanted to point out with this stock is, as you can see here, the stock fell with the broader markets. The beginning of the year was very, very difficult for stocks. Huge sell-off in the broader markets. But as the stock is recovering, and more importantly, breaking out to new highs, huge volume, and these are 3 weeks in a row where the stock had tremendous volume as it continued to break out. And of course, the stock has gone on to bigger heights, to higher highs. And this is indicating the beginning of institutions really coming back into the stock. I did not put a heading on this, but what we are looking at here is the broader markets. And when looking for signs of the broader markets breaking down or being supported and under accumulation, you want to use those same volume characteristics. So this is a weekly chart of the S&P 500. And what I wanted to point out to you are two different time periods. This, of course, is the beginning of 2016, and I mentioned that that indeed was a very, very tough period. Lots of big selling. But if you were really paying attention to the broader indexes back at the end of last year, and in fact, many of our clients, we were advising them that to be cautious on the broader markets, and here's why. This is December, and we did see the second to last week volume selling, but that last week in December was huge volume as the market sold off. And I'm sorry, this is the first 2 weeks in December. The markets, we were getting volume. And then the third and fourth week, holiday shortened, we didn't see quite as much activity. So those first 2 weeks, we were seeing quite a bit of selling on volume, indicating a red flag. And of course, those first couple of weeks in 2016, huge volumes. So now let's take a look as the markets are trying to recover. They're coming back in. You're not sure if you can believe that the markets have reversed. Your signal, again, is going to be this big volume. So this is taking you to the end of February, the beginning of March, and you are getting very, very big, well above average volume each week, indicating that the institutions are in there, they're believing, and a lot of individual stocks were starting to turn. Some of the NVIDIAs of the world were coming up with big volumes, so that would help support your conclusion that this downtrend indeed had reversed using the volume. So what are some conclusions? We've reviewed the charts. We've talked a lot about different definitions and technical overlays. Well, ideally, hopefully you've been able to see how critical volume is in timing your trading and in helping you decipher whether, again, a reversal has occurred or not, or whether a breakdown is occurring. And I mentioned be sure and have a system in place. Because this tool is so critical, you will want to have either a screening of your universe of stocks or those stocks that you own. And again, a number of trading platforms now do indicate whether the action is on above or below average volume, but hopefully you've been able to see how really critical volume is. And I mention this a lot, know yourself. If you are devoted and you have the time, you're really going to be rewarded by, again, continuing to look at educational webinars, looking at history, using it as a guide. If you don't have the time to devote, I would suggest subscribing to a newsletter. My particular weekly Edge report, I mark up charts regularly and identify why we find a stock to be poised for a big uptrend. And oftentimes volume is a very, very key component of that. And by viewing that kind of thing on a regular basis, it's really going to help educate you so that you can go out and spot those stocks on the move. This last item, and I did not mention it, but there is a special offer for those of you that are watching today. And in this particular case, it is this is a course that teaches you the 6 characteristics of a winning stock from my time at O'Neill and throughout even recently, my work is to review charts, thousands of them each week, and always on the lookout for these big winning stocks. And by winning stocks, I mean stocks that are up at least 100%, in many cases up 1,000%. And these stocks, what has been uncovered over the years, have each of these winning stocks have characteristics that are similar right before they have these huge moves. So this goes through those 6 characteristics. There is one characteristic that absolutely every stock has to have before these big moves. So you will be given those traits, and then also historical examples, and it'll provide you with precedents. It also provides you insights as to where you can uncover these characteristics. Usually this item is close to $300, but today it is being offered for $39. You can access it using the link at the bottom of this chart. If you'd like more information about my work, you can visit my website, and that's on the bottom right. It's meminvestmentresearch.com. And then for those of you that are interested, I'd be happy to answer any questions that you might have. And it does appear that we have a few questions, so I can go ahead and the first one is, will this be recorded? And yes, it has been recorded, so you can receive a copy of that. Let's see. I wonder if you could reserve a moment. Okay, is volume also applied to the Forex market? And I apologize, the Forex market is not a market that I actively trade, so I'm not comfortable answering that. But I can say for the US, for the markets, the broader US markets, and also in international markets, ETFs, and otherwise volume is very critical. Jose is asking about dark pools and how they affect the accumulation distribution. And I do realize that dark pools are a big part of the markets out there today, but I have found, having been an investor and been studying charts over 25 years ago and then studying them now, the accumulation distribution characteristics still hold relevance. And I think by my examples, hopefully you've been able to see that there is still importance that can be taken from studying volume. And someone else thought that we were supposed to use OBV, and that indicator, it's off-balance volume that you can use. It's if for those that want more information on that, stockcharts.com goes into that. But I stuck to the other indicators that were used today. Let's see. And so we're talking about high volume, and I'm not quite sure the question relative to how to use time with price and volume. And I think perhaps, Leon, you might be referring to daily chart versus weekly and intraday. And really that volume characteristic is going to be relevant no matter what time period you are using. I will say for broader, bigger moves, weekly up on volume screens can be really helpful. But also you want to pay attention each day to your stocks if they are breaking up and down on volume. So it really also depends on your timeline. Are you a day trader, as far as which time frame you would use? The $7 on the screen is referring to an offer to receive my weekly report. For $7, you can receive 4 weeks of that. Normally it is $97 per month, but you can go ahead and take a look at it for 4 weeks, which is an incredible offer. And Yes, each week you are getting, with that weekly report, a stock list. And right now that list is at about 18. It ebbs and flows with the broader markets, but these are stocks that have been picked up perhaps last year, earlier this year, and then each week one to three new names are added that are exhibiting. And again, it's going to depend on the broader markets. And then how is this course different from the momentum course? That's a great question. This course goes into quite a bit more detail, and the examples are much more relevant because what you're looking at is keying in on about 8 different big winning stocks, as opposed to current ones. We're not sure if they're going to be big winning stocks. And again, it really drills down. It gives a lot more in the way of details as far as what's involved and where you can find those different characteristics. Now, someone mentioned that these charts look obvious in hindsight, and gosh, this is from JQ. I can hear what you're saying, but this is where practice is going to come into play, because I will tell you that when you really become good at viewing charts, putting those technical overlays on top, a lot of times, and for instance with my weekly newsletter, I will put stocks on there. I have put EW as a for instance, and NVIDIA and some of the others we've mentioned, after they've gapped up in price, because I can see that there is, given the technical overlays, given the overview of the markets, that this stock has more upside ahead of it. But this is after 25 years plus. It doesn't take that long, but it does take time, and you will there'll come a day that light bulb will go on, and you'll be able to identify it in live time as opposed to in hindsight. And then another question is, how is it high volume but no price change, and low volume with high price change? Okay, so you want to know if, for instance, there's high volume and there's no change in the price, but it's occurring on no volume. And if that occurs more than one day, that is what's called stalling, and that can be a precursor to downside. But it's the buyers and the sellers fighting for space, and that stalling action, again, high volume, no price movement is many cases precursor to a downside, and then low volume, and then the price moves. That often occurs in very thinly traded stocks, smaller cap, and that is why these stocks, they're harder to trade, because you'll see big price swings but not on a lot of volume. And so that is not, you want the volume to be there to confirm that that uptrend is going to continue. Oftentimes, if it's on low volume, it will fizzle. And so James wants to know if I am a one-person operation. I actually have a team. There are 3 of us, and but I do most of the research. The rest of my team is more administrative and graphic design and so forth. And Leon could not see the $7 link. Darn it. Well, I'm not sure. I see. Okay, yes, you're right. The link is not there. So what you would need to do, I can go ahead and email you that link. And James wants to know my motivation to sell instead of just trading. James, I do very actively trade my own account, and I do so quite successfully. But at this point in time, I am still my primary client base is institutions, and I've worked with them for over 15 years. It's a relationship that I don't want to give up. More recently, I have opened it up to individual investors, mostly to share the knowledge that I have. That's really important to me right now. I did have an event personally where my husband had very, very serious health issues, and it kind of woke me up. Our time is limited, and I enjoy educating and helping people, so that's the primary purpose. And then Karim wants to know, do I mainly deal with options or stocks? I primarily work with stocks, although I do have clients that use the service and trade options with them. That's not uncommon at all. So I don't see any other questions. And again, I want to thank you for taking the time out of your day to review this. So, I do have a couple more here. Downloaded an ebook in July. Good, Thomas, and hopefully you found that useful. That was from my website. That's a free ebook. And again, thank you for taking the time. Oh my gosh, your one last question. Volume. Volume is not one of the 6 key. It's critical, but not one of the 6. And I will end it with that. And thank you again.